If you're a real estate agent earning $200,000 a year and you want to grow your passive income, this show is for you. Learn secrets other agents use and hear from experts in our field who will guide you on your journey to investing in assets like apartment communities so you can take your commissions and turn them into cash flow. Here's your host, Randal. Let's dive in.
Hey, great to have you on today. I'm excited to talk to you about something near and dear to everybody's heart. It's taxes. Taxes are so exciting. Today, or just this past week, we got our cost seg study estimate done. So we don't actually have the study done yet, but we had two different firms look at this property that we're buying. And what you do is you get a cost segregation study done on it. We've done a number of episodes on what a cost segregation is. I'll high level it right now. Okay, so when you do cost segregation, you're compressing the time frame on some of the items that you can depreciate. You can do 15-year and 27-year. And so what's happening when you run the cost segregation study, normal depreciation could be over a 27.5-year period. And so year one, in this scenario of our property, we'd only be getting depreciation of about $29,000. When you run the cost segregation analysis and you see that a lot of that stuff is personal property and that can be depreciated over a much shorter time frame because it's going to depreciate faster, and you layer on this current tax advantage that we have of 60% bonus depreciation, we can get our depreciation in year one all the way up to about $180,000 to $190,000 that we can write off. And the way that's beneficial to us as the operator is we are active real estate professionals. So we can take all of that depreciation and apply it to our active income, any income that we have, to reduce our tax liability. And so that's a loss that we can put on our books, right? We have investors that come on with us, same thing. We can allocate that depreciation. And as an investor, you get some of that depreciation and you could use it to write off. If you're a real estate professional, you can use it to write off 100% of other income. If you are a non-real estate professional, and talk to your CPA, I'm not a CPA. This is all going to be driven by a CPA. But if you're a non-real estate professional, you can use it against passive income that you have earned. Or passive gains. And so like if you invest in stocks, trade stocks, do whatever it is, or you're getting interest income from loans you've created, anything like that, those are all passive. They're coming into you and you can use this depreciation to write off those gains. Interesting thing about this as well is it carries forward year over year, sits on your books. So if you only use, say it's $200,000 depreciation that we get from this property, if we don't use all of that against income this year, then we can carry that forward to the following year or however many years you have it on your books. So if you go out and you're buying 1, 2, 3, 4 of these properties every year, you're using your own money. I mean, you could build up a pretty quick book of losses that you can carry forward for years to come. And so that's one of the reasons we love buying real estate, because you get the tax benefit of owning the real estate. And as an investor in some of these deals, if you're a limited partner or if you are a joint venture partner in these things and you have no active management role, you can still get those depreciation losses on your books as well. So anyway, I was just wanted to share this with you guys because there's a $1.2 million purchase, give or take, we'll be all in for 1.4, 1.5, I would say, something like that, depending on how all the repairs go. And we're able to get a depreciation. Sorry, let me clarify that. The purchase alone gets us about $200,000 of depreciation. If you go and you include any CapEx items that you are buying, if you have to get new refrigerators, stoves, personal property items like that. We have all window units in this property. It's all personal property. All of those things are going to be depreciated a lot faster. And so your depreciation in year one, if you're going to spend all that money in year one, is going to go up. Okay, so just to clarify, when you have a CapEx budget that you are going to spend on the property, that's also, most of it's going to be depreciation that you can use and take advantage of very quickly because you're spending that money up front. So those new items that are going to go in, you're going to get some of that depreciation up front. It's not going to be massive against the actual purchase of the property. And so you can get two different schedules. You can get a property specific cost segregation study done, right, as it is today. And then you get another one done that includes any of the new items that you're going to be putting into the property. So you just have to think about if that's going to make sense for you. It's a little extra cost to do that. And it doesn't really, I'm looking at it now. It looks like with the cost seg bonus depreciation, let me look at this schedule. In year one, you get $79,000 of depreciation. And then without the cost seg, it's 75. So it really doesn't move the needle much. It's a $4,000 change, but it costs about, half of that to get just this study done. So anyway, something to think about in numbers to review whenever you're going through and taking a look at it. The bonus depreciation, if it goes back to 100%, which there's some legislation going through Congress, I believe right now, advocating for 100% bonus depreciation coming up. And so if that happens, then these numbers will look even better and you get more of that depreciation up front. Again, this is not tax advice. Talk to your CPA how this would affect you and your taxes whenever you are looking at either a syndication or a fund and they're offering this type of advantage. Whenever you're going and buying a property, you can get one of these studies done up front and you can look at your PPM, the private placement memorandum that the sponsor has provided, to see how much you are likely to get in depreciation for your investment. So again, all those things, just keep those in mind whenever you're looking at these deals. I just want to share exactly what we're looking at on this specific deal so that, again, if you're looking at something like this, a property of any size that you can do a cost segregation study on, just to help you understand what it is that we're looking at. I've got 2 different bids, 2 different cost seg companies that have looked at it. I suggest you do the same, shop around, kind of figure out what the price points are for these types of studies, and then take advantage of them for sure. So again, if you're getting good information out of the show, if you're enjoying the content that we're putting out, the guests that we're bringing on, please go on, rate and review. You can check out the live shows on YouTube. If you're listening to it on podcasts, anywhere you listen to it, please just rate and then give us a quick 1-word review. Even just 1 word just helps us out a ton with the reach, and that gets better guests on the show. All right, guys. Enjoy. We'll catch you on the next episode.
Did you know that 80% of the agents we speak with got into real estate in order to gain passive income so they could obtain financial freedom and become work optional? If you want to stay up to date, the best way is to make sure you're subscribed. So if you haven't done that, go ahead and do it now. We'll catch you on the next episode.